Hello friends, today we are going to see different types of mutual funds available in the market. Mutual funds can be broadly divided into open-ended funds and closed-ended funds. Open-ended funds can further be divided into equity fund, debt fund, balance fund, and money market or liquid fund, while closed-ended funds can be divided into capital protection fund and fixed maturity fund. Let us go into the details. Open-ended funds. These are the funds where units are available for purchase or redemption throughout the year. All purchases/redemption of these fund units are done at prevailing NAVs. These funds allow the investors to stay invested as long as they want. Generally, there are no limits on how much can be invested in the fund. They can be actively or passively managed. Actively managed means that there is a fund manager decides where investments will be. Passively managed means that the fund manager will make an investment similar to any index. They are an ideal investment for those who want to make an investment along with any time liquidity option because generally they are not bound to any specific lock-in period. Close-ended funds. These are the funds where units can be purchased only during the initial offer period. Units can be redeemed or withdrawn only at a specified maturity date. To provide for liquidity, these schemes are generally listed on a stock exchange for trade. Unlike open-ended mutual funds, once the units are bought, they cannot be sold back to the mutual fund house and can be only redeemed through stock exchange. Equity fund. An equity fund is a mutual fund scheme that invests predominantly in equity stocks. As per current SEBI mutual fund regulations, an equity mutual fund scheme must invest at least 65% of the scheme's assets in equities and equity-related instruments. Different type of equity fund can be large-cap equity funds, mid-cap equity funds, small-cap equity fund, multi-cap equity funds, ELSS, equity-linked savings scheme, etc. Debt funds. A debt fund is a mutual fund scheme that invests in fixed income instruments, such as corporate bonds and government bonds. Debt funds are also referred to as income funds or bond funds. Different types of debt funds can be short duration fund, medium duration fund, dynamic bond fund, corporate bond fund, credit risk fund, gilt fund, banking and PSU debt fund, etc. Balance fund. A balanced fund is a combination of equity component and debt component in a single portfolio. Balance fund's equity component generally varies from 30% to 80% depending on the fund's mandate. These funds invest in a mix of equity and debt, giving the investor the best of both worlds. Balanced funds benefit from a healthy dose of equity and the debt portion fortifies them against any downturn. Equity portion can help in beating inflation and debt portion can help in capital appreciation over a period of time. Money market/liquid fund. Liquid funds, as the name suggests, invest predominantly in highly liquid money market instruments and debt securities of very short tenure and hence provide high liquidity. They can invest in very short-term instruments such as treasury bills, T-bills, commercial paper, CP, certificates of deposit, CD, and collateralized lending and borrowing obligations, CBLO, that have residual maturities of up to 91 days to generate optimal returns while maintaining safety and high liquidity. The returns typically take the back seat as protection of capital remains of utmost importance. Investors usually consider them as an alternative to banks' saving account. Capital Protection Fund. As the name suggests, capital protection funds are mutual fund schemes that aim to protect at least the capital, that is, the initial investment, and providing an opportunity to make additional gains, as per the market returns. In short, a capital protection fund aims to safeguard the principal amount while offering a potential for capital appreciation. The structure of fund is oriented towards protecting the principal. That is, by the end of the stipulated term, The debt portion of the fund grows to give you back the principal, while the equity portion brings the potential upside. It is important to note that there is no guarantee of returns or guaranteed capital protection. Fixed maturity fund. Fixed maturity fund, as the name indicates, have a predetermined maturity date, like a term deposit, and are close-ended debt mutual fund schemes. They invest in debt instruments with a specific date of maturity, lesser than or equal to the maturity date of the scheme. They also enjoy the status of debt funds. After the date of maturity, the investment is redeemed at current net asset value, NAV, and the maturity proceeds are paid back to the investors. So friends, thank you very much for watching the video. If you like this video, then please like, share and subscribe for more investment related videos.